Welcome to this explainer on continuous operation costing. Have you ever actually stopped to wonder how a massive factory figures out the precise cost of a single drop of gasoline, or maybe just one bag of cement out of the thousands they churn out every single day? Well, today, we're going to act as financial detectives. We're going to track every single lost cent on the factory floor, all the way from massive heaps of raw material straight to the final product you buy on the shelf.
Here is our factory blueprint for today. We're going to cover 1. The mass production formula, 2. The assembly line flow, 3. Unfinished business, 4. Inevitable spoilage, 5. Splitting the joint costs, and finally 6. Costing non-physical services. Let's get right into it.
Section 1. The mass production formula. We really need to look at the big picture first to understand why mass production requires a completely different mathematical approach than, say, building a custom house.
The absolute biggest distinction here is the size of the denominator. Think about order costing for a second. This is for unique, tailor-made goods. If you're building a single bridge, your denominator is 1. You literally track every bolt and every hour of labor directly to that specific bridge. But then we have process costing, which is our main focus today. When you're producing millions of liters of kerosene, you obviously can't track the exact cost of one specific liter. Instead, process costing relies on broad averages over a continuous period. You basically take all your accumulated costs, the whole shebang, and divide them by your massive denominator.
Moving on to Section 2, the assembly line flow. Let's see how these materials physically move through a step-by-step operation.
Think of a giant conveyor belt. In process A, raw materials go in, workers do their thing, and factory overhead, like electricity, is applied. But here's the real magic trick of process costing. The completed output and the accumulated cost of process A literally becomes the raw material input for process B. Process B then adds its own materials, its own labor, and its own overhead before transferring the totally finished good to the warehouse. It's essentially a continuous baton pass of physical goods and their financial values.
Section 3. Calculating unfinished business. This is where we hit our first major accounting hurdle. What happens when the music stops?
Seriously, how do we account for goods that are stuck halfway through this assembly line when the accounting period officially ends? Imagine it's the very last day of the month and you're a shoemaker. If you only finished half a shoe by the time that factory bell rings, how do you accurately assign a value to it on your ledgers? I mean, you can't call it a whole shoe, but you also can't just pretend you didn't spend money on the leather and the labor to get it halfway done, right?
While the elegant mathematical solution to this headache is a concept called equivalent units. This simply translates partial progress into a fully completed equivalent. Think of it like this. If you have two shoes that are each exactly 50% complete, financially speaking, you have one equivalent unit of a completed shoe. This is huge because it allows us to spread our costs fairly over both our finished goods and our work in progress.
Let's look at the L. Semco shoemaker's example to really nail this down. Imagine we have 2,000 partly completed shoes just sitting on the line. We actually have to treat each cost element separately because, they don't all happen at once. For materials, maybe 80% of the required inputs have been used, which gives us 1,600 equivalent units. But what if the workers are a bit slower? So only 60% of the labor has been applied, yielding 1,200 equivalent units for labor. By breaking it down piece by piece like this, we get a perfectly precise valuation of our unfinished business. All right, Section 4, Handling Inevitable Spoilage. Now it's time to solve the mystery of the missing money. What happens when physical materials evaporate, shrink, or just get completely ruined in the machines?
Look, in literally any factory, some loss is just a fact of life. We call this normal process wastage. Think of a sugar refinery. A certain amount of moisture is simply going to evaporate. There's no way around it. Because this is completely unavoidable and expected under efficient conditions, the cost of that evaporated liquid doesn't just disappear into thin air. Instead, it is logically absorbed by the good units that actually survive the process. The cost of getting those good units absolutely necessitates those normal wastages. But then we have abnormal process wastage. And this is the stuff of factory manager nightmares. We're talking a machine breaking down, a massive batch of materials turning out to be defective, or human error just ruining a run. This is totally unexpected. So the crucial point here is that this kind of failure hits your profit and loss account directly. You cannot bury abnormal losses in the cost of your good products. If you did, you'd artificially inflate the value of your inventory with the cost of your own mistakes, and we definitely don't want that.
Section 5. Splitting the joint costs.
Let's build on this into an even more fascinating scenario: joint products. Imagine a single raw material, like crude oil, gets thrown into a massive vat and literally splits into multiple distinct, usable products. The magic moment here is what we call the split-off point. This is the exact phase in production where products diverge and take on their own completely individual identities. Before this point, all the costs are mixed together as a joint cost. After the split-off point, we start classifying the resulting items by their relative value. The big moneymaker, that's your main product. Secondary items that still have significant value, say 15 to 40% of the main product's cost, are joint products. And those minor incidental outputs, costing maybe 10 to 15%, those get classified as byproducts. So how on earth do we actually share that initial massive joint cost among the products once they split? Let's use the Anaderia Company example, which produces three things: product K, S, and T. If we use the physical units basis and the total joint cost was 1 million naira, and product K makes up 50% of the total physical kilograms produced, well, we strictly assign 50% of the cost to product K. It's incredibly straightforward, right? But actually, scratch that. It has a glaring flaw. It completely ignores how much these products will actually sell for.
While dividing costs by physical weight is super easy, it isn't always fair. What if the heaviest product is essentially worthless gravel? We could use sales value at the separation point, but that ignores the fact that some products need really expensive marketing or further refining later on. This is why calculating the net realizable value, or NRV, is widely considered the gold standard. NRV takes the final sales price and subtracts the separate processing costs needed after the split-off point. It gives us a much truer picture of each product's actual financial weight.
Section 6. Costing non-physical services. For our final section today, we're going to pivot a bit. We're going to take all these heavy manufacturing formulas we've just learned and see how they seamlessly apply to the invisible world of the service industry.
In service costing, the foundational math remains exactly the same. We're still dividing total cost by a huge denominator to find an average, but that massive denominator shifts from physical items like bags of cement or liters of oil to abstract service units. For a hotel, the cost unit is an occupied room day. For a hospital, it's a patient day. We are still continuously tracking costs. We're just applying them to units of time and human experience rather than physical, tangible goods.
To make this completely concrete, let's think about a transport business. Just like a factory has overhead and materials, a transport fleet has fixed charges, things you pay regardless of how far you actually drive, like insurance and licenses. Then you have running costs, like fuel, maintenance, and lubricants, which fluctuate based on activity. To find your exact service cost unit, you simply aggregate your fixed standing charges with your variable running costs and average that total over the total miles traveled or the weight carried. It's essentially process costing just on wheels.
As we wrap up this explainer, I really want you to just look around you. Think about the fuel in your car, the sugar in your morning coffee, even the shoes on your feet. Consider how the strict accounting of these invisible factory floor realities, the evaporated liquids, the equivalent units of halfway finished goods, the dividing of joint costs, quietly and powerfully dictates the final price tag of almost everything you touch. It's not just dry accounting, it's literally the mathematical blueprint of our modern, mass-produced world. So how do those invisible processes secretly shape the prices you pay every single day? Thanks for joining me, and keep questioning how the world is put together.